Dharamshi joined just now, CEO, CIO with ValueQuest Investment Advisors, and let's connect with him. Ravi, good morning. Thank you for joining us. So, Ravi, what are we starting with? Market, your investment in Wari, how banks have done well, or the fact that the Prime Minister and the Parliament yesterday did indicate that PSUs in general are doing very well. You can choose 4 options.
Hey, good morning, Nikunj. I will stick to what I understand. I have no idea about the politics, so I'll stick with the market. So, no, I think you've been discussing that we are probably in a small minor corrective phase in the markets, but I think the larger uptrend still remains intact. In fact, I don't see any reason why we should be correcting any deeper than 5-7%. And of course, in such kind of a scenario, it's not like it's a uniform correction across the board. Something or the other still keeps doing well. So might as well focus on playing the larger trend than trying to understand these small minor moves.
Why do you think the correction will not be more than 5-7%? What gives you the conviction?
See, I'll tell you what, slightly elongated answer is that we are early in the stages of the business cycle of this country. Okay, our corporate PAT to GDP bottomed at around 1%, has bounced back to about 4.2%. In the 15-18 month period when the US was raising the interest rates, we had a $40 billion outflow. At that point of time, we were facing some margin issues because raw material prices went through the roof and freight costs went through the roof as well. So there was question mark on growth and the margins were dipping. But we negotiated that phase quite well with just a 15-17% kind of a correction and a sideways, probably a sideways move over a 18-month period. So now, and India Inc. remains largely deleveraged, unleveraged. So there is no reason for us to have a big crash. It's not like we are all the corporates are putting up large capex with taking on huge debt and throwing caution to the wind or any such thing. Even for that matter, in the market, the leverage is on the lower side, I would say, because the SEBI has tightened the screws so much on the leverage side that there is no way for margin funding market has pretty much come down. IPO funding market has come down. So there is no reason for you to believe that there is any kind of a crash in the waiting. The margin issue that we faced in the 18-month period is now correcting because the leading indicators pointing to the margins are beginning to look up. So raw material costs, freight costs have come down. Growth is sustaining itself, and operating leverage will play out as the utilizations levels increase. So all that gives me the confidence that yeah, there can be correction. It's a natural course of thing, but there is no crash in the offing.
Specific in terms of themes with you, something which we've discussed. You've been bullish. You've been bullish on manufacturing, and some of your investing companies have done rather well for themselves. Do you still feel that after the recent run up in some of the EMS stocks, they still have a long way to go, and you will not be tempted to book profits even though some of the stocks are up more than 100 to 150% in last 3 months?
So I'll refrain from giving what actions we are taking in the portfolio, but I can tell you this much, that this is the beginning of a large trend. India is still a very small player in the global scheme of things in the electronic manufacturing. And this China plus one theme is not anymore a figment of imagination or a great boardroom talk or anything. That boardroom talk is now getting converted into inquiries, which is getting converted into orders. So while the world is actually slowing down or facing a slowdown, Indian small companies are actually facing fantastic demand. In fact, order books are getting swelled to the extent of next 3-4 years. So that tells you that this China plus one is a real thing. But it is a theme that will move from sector to sector. It's not necessary that all sector face this kind of a demand situation across the board simultaneously. For example, chemicals is one sector which actually was early in this cycle. It started from 2014 when China was facing pollution issues. But now actually China is coming back in the chemicals market, and that is causing some demand as well as margin issues for the domestic players. But other sectors like renewables or the one you mentioned, electronic manufacturing, is just about picking up. So we are still doing low-end work. It's largely assembly work, but we will move up the value chain over a period of time as more and more OEMs like Samsung, Apple, all they set up their base in India. even the semiconductor manufacturing players, that will give rise to the ecosystem in India, and we will also move up the value add chain. So I am not worried about the near-term overvaluation. You will have to probably live through a year of underperformance or no great performance, but the larger story remains intact.
Because what to invest in is also what to avoid, right, in the market. And, just looking at the commentary coming in from most chemical manufacturers this time around, it seems like they're going to be in the slump for a while. And also wanted to get your thoughts in on IT. When do you see a meaningful recovery kick in?
Hi, Aisha. Good morning. No, you're right. I think China plus one story panned out much earlier in the chemical space, and we are facing a headwind in terms of Chinese chemical players coming back to the market. And the protection that we had in terms of anti-dumping duties are probably slated to retire. So in case of chemicals, what happened was they were shutting down production in a particular region, and they were moving to a different region. The Chinese government had mandated them to shut down production and move it to a different place. And that is exactly what has happened. So over a 5-7 year period, those guys have actually moved to a different regions, and now the production has commenced over there. So you will have to pick and choose. Not every chemical company is likely to be able to survive a Chinese onslaught. That window of opportunity actually has kind of come to a close over there. Now it will up to the merit of the company whether they are able to sustain the Chinese onslaught. So I am not in a hurry to place any kind of bets in the chemical sector currently. I think we'll get better valuation for sure. And just to rewind, 2014-15, all these companies used to quote at a less than double-digit multiple. So today they are easily quoting at 35-40 multiple, and people are not asking any kind of question. So I think there is some amount of complacency in terms of business outlook as well as valuations.
So Ravi, let's divide the market in perhaps 3 buckets. Less than 1 year, 1 to 3 year, 5 year plus. If you have to pick your spots in these 3 buckets where you think there is reasonable chance of outperformance, how would you divide the market? Less than 1 year, 1 to 3, 5 plus.
So, Nikunj, I'll refrain from commenting on less than 1 year. There is no way for me to figure out what will do well in 1 year. So, for example, pharma, we have remained largely out of market, but it's been the best performing sector in the last 1 month. And basically, we believe it's a reversion to mean trade, and it is not a secular upturn that is happening. So, some amount of when a market is undergoing a rotation, it usually happens that the relatively cheaper sector gets its own turn as well. So that's exactly what happened with pharma. But from a more 3 to 5 year perspective, and again, I will refrain from saying beyond 5 years also, because the world keeps changing drastically in 5 years' time. 3 to 5 years is where we are probabilistically likely to be more right than wrong. So on that time frame, I still believe that the manufacturing story will pan out. The overall in India incorporates growth story, which will lead to re-leveraging cycle, that will pan out. The consumption should pick up. Currently, consumption is undergoing a tough period, and maybe another couple of 2 quarters, some amount of consumer discretionary pressure will remain, because the post-COVID revenge consumption that we saw is kind of subsiding, and that is leading to normalization. But post that normalization, I believe consumption-oriented companies should also start doing well. For example, real estate continues to be strong, but the ancillary to the real estate, the building material, should also start picking up. They are more a lagging sector to the real estate demand. So these are the sectors which I believe over a 3 to 5 year period should continue doing well. Capital goods is another. I mean, it's part of the manufacturing also, in the sense that the capital cycle is just picking up, and it is a very broad-based cycle. So these 4 sectors still look very good to us from the next 3 to 5 years perspective.
Ravi, I got a press note which says that your firm has done another round of funding in Vari. Now, I just want to understand what has changed so dramatically for this entire renewable and solar energy space. Because globally also, if I look at the order books, they are bulging. If I look at the total capacity addition, what India has done and what America has done, these numbers are looking very strong. I mean, we both visited the management, I think, in the month of May. But post that, the market narrative, the opinion, the appetite, a lot has changed for that sector.
Yeah, so Nikunj, first of all, I wear two hats. One is, of course, the public market, and other is the private equity. We have launched a private equity fund, and the investment that we are talking about over here is through our private equity fund. Coming to what has changed, I think we have passed the tipping point globally in terms of acceptance of renewables or the acceptance of the narrative that the climate is changing and we need to take actions for the same. So we are trying to move away from everything that is fossil fuel, everything that is polluting, towards renewables and more circular economy. So to that extent, the government buy-in is there, the corporate buy-in is there, the individual buy-in is there. The money is flowing towards these sectors, and it, as you rightly mentioned, it is visible in the order book. So it is not like we are alone in this. It's a huge, one of the biggest opportunity over the next 10-20 years that is panning out, which is energy transition. And it will, again, this will manifest itself in various sectors. Solar is the first one, and actually wind was the first one 15-20 years back, but it ran into its own troubles where the kind of the subsidies ran out, the accelerated depreciation, kind of regulatory support has waned for wind, and wind has its limitation in terms of site and all. But solar, if you think of it, solar is the cheapest form of energy that mankind has created ever. And I'm talking about barring the fact that we can rub two stones to create fire, but that we can't do at scale. So solar is the cheapest form of energy, and this the prices have fallen 90%, and they will fall another 90% from here over the next decade. If that was to happen, essentially, like we take in the Maslow's hierarchy of need, the bottommost, now the new layer that has come is Wi-Fi. We almost expect connectivity to be available everywhere. Over a 10-year period, we'll expect electricity to be almost available everywhere. So with that kind of a change happening, I think the sector has a large runway ahead of itself. But now for Indian players, there are two trends that are panning out. One is, of course, the adoption of renewable energy, and the other is the supply chain shift away from China. In this particular sector, we are completely dependent on China. We, as in the world, is completely dependent on China. And incrementally, they are trying to wean away. So they are looking for Indian suppliers who can provide a reliable panel throughout the next few years. So that is a window of opportunity available to the players like Waaree, and I think they are doing a good job of capitalizing on it.
What's the outlook, Ravi, morning, on the compounding story within the entire banking space and even the PSU bank's performance?
So I would say that financials is one area where there is a combination of value and growth available. Most of the other places, either if the story is growth story, then the valuations are pretty much recognizing the same. But if it is a value story, then there is only a reversion to mean happening. So financials are one place within that lending financials where we are going to witness a good 15-17% kind of a growth over the next few years. The asset quality cycle has just bottomed out to a couple of years back. The releveraging cycle is just starting in the economy. So I'm not worried at all from the asset quality point of view. And the little bit of hiccups that happened because of the interest rate, right, which leads to margin compression, those kind of things will have to be taken into stride. But the valuations are still very, very reasonable. Even for some of the large banks, 1 year forward price to book multiple is below 3.5, and historically they have quoted far higher. I'm not saying they will go back to those kind of multiples, but even at this point of time, there is still scope for valuation expansion. Coming to the PSU sector, we avoid playing the PSU banks. It's not a sector, so to say, but incrementally the story is against them. I mean, no offense over here. I think they are a great reversion to mean stories. It's just that we look for secular stories and we don't look for reversion or just a valuation correction story. So that is the reason why we avoid, because every 3 years the top guy probably changes over there and undertakes a correction of books, and essentially they are a Me Too player. They used to form a syndication and give loan to whoever the largest bank of the country was giving loan to. We would rather that besides giving loan, they know how to recover the loans as well. And there needs to be some amount of continuity in terms of the management, so that these top honchos of the banks need to get a 5-7 year run. Then we can get a cycle where we can hope to play.
Market, you're confident of compounding both because of earnings and PE.
Sorry, I didn't get
in
your
this
question.
market, where do you think the magic of compounding could work, both because of P re-rating and because of earnings? I mean, that's the most potent combination, right?
Yeah, so definitely financials is one such space, but within financials, we are bullish on lending as well as non-lending financials. So some of the insurance companies, post their listing, they are very highly valued. Over the last 4-5 years, they have corrected significantly. The competitive intensity over there has been very high, and now that competitive intensity is actually kind of bottoming out. The regulatory push was also very hard, and I think the regulatory push is also now easing. So I think insurance is one such space which I believe now, which has a growth cycle ahead of it, and the multiples have now become reasonable. Similarly, I mean, just like I mentioned in the previous thing about the lending financials, whether it is large bank, whether it is affordable housing, there are many segments within financials where we believe there is a scope for both growth as well as re-rating.
Ravi, how much time more before you have to log on to your meeting? Another 5 minutes, or I need to really let you go today?
No, I'm sorry. I'll have to
Oh,
drop off
बहुत
over
कम time है तो Ravi.
No. Thanks a lot. I'll drop in again soon. Don't worry.
All right. Have a great day. Thank you very much for joining us. What do we have on the market? There's another